March 30, 2026 saw an aggressive collision in India's stock market. Foreign investors sold over 11,000 crore rupees of shares in a single session. This scale shows the monthly totals. Overseas funds withdrew roughly 1.2 lakh crore rupees, but domestic institutions countered by purchasing approximately 1.43 lakh crore in the cash market. Despite the domestic buying lead, the Nifty 50 and Sensex fell over 11%. Financial indices suffered even more, dropping up to 20%. This created a mathematical mystery. If domestic institutions bought more shares than foreign investors sold, why did the market suffer its worst month in years? Portfolio managers don't examine India in isolation. Amid rising oil prices and West Asian conflict, foreign funds compared Indian valuations against South Korea, Taiwan, and Brazil and reduced their exposure. This tree map breaks down the Nifty index. Foreign investors concentrated selling in banking, withdrawing 60,655 crore rupees. But net figures don't reveal direct counterparties. Domestic funds weren't necessarily buying the specific banking stocks foreign funds dumped. Market prices are ultimately determined by the prices at which buyers are willing to absorb the shares offered. Selling concentrated in index-heavy banks drags the headline indices down, regardless of the buying activity in smaller companies. Domestic capital begins far from the trading floor. It starts with an instruction to debit a fixed amount from a bank account, the systematic investment plan. This equation explains mutual fund assets. The new money entering is the flow. In March, SIP contributions reached a record 32,087 crore rupees. Yet the ending assets still shrank. Plummeting prices caused a 3.42 lakh crore rupee loss. The market's decline overwhelmed the new contributions. While these losses reduced total wealth, the continuing SIPs provided portfolio managers with fresh liquidity exactly when other investors were selling. SIPs were only one part of the rescue. The 1.43 lakh crore of domestic institutional buying was 4.5 times larger than the month's SIP contributions. The rest of the capital came from a wider ecosystem. First, insurance premiums. Next, pension allocations, and existing mutual fund cash reserves. This chart shows how domestic funds absorbed the selling. When foreign funds offered shares at 100 rupees, buyers waited. At 90, institutions deployed cash. But while foreign selling arrived in concentrated bursts, domestic buying was fragmented across many different mid- and small-cap companies. The domestic institutional ecosystem functions as a shock absorber. It prevents a disorderly market failure, but it does not act as a fixed floor that keeps prices from falling. When a domestic fund buys an existing share from a departing foreign investor, the money goes to the seller, not the company. This transaction transfers ownership and future risk. It does not finance new corporate expansion. During this period, domestic institutional ownership officially overtook foreign ownership across the NSE-listed universe. Overseas ownership fell to around 15.8%, its lowest level in 17 years. This dashboard shows the first signs of stress in the domestic wall. During the crash, equity fund cash reserves fell by 24%, while the SIP stoppage ratio ticked above 100%. More plans were closed or completed than were newly opened. If households lose confidence and pause their SIPs while mutual funds are low on cash, the stabilizing mechanism could weaken from both sides simultaneously. India has traded market immunity for a new form of dependence. The system no longer relies on the risk appetite of global investment committees. It rests on the continued income and behavioral discipline of millions of Indian households.